Welcome to It's No Secret, a podcast for those who want their money questions answered.
Join us as we talk to real Kiwis and share truths about our own financial lives, because the truth is, there is no secret to achieving financial freedom.
Hi, lovely listeners. Welcome back to another episode of It's No Secret. This episode is part 2 of a 2-part series about personal insurances. Last episode, we just got a bit carried away talking, so we're now back with the second half of the episode. I hope you enjoy. Let's jump in.
Okay, back to the cover. So, oh man, this is really tricky because they're all in various amounts. So that 1.8 is $2,800 a year.
Okay.
But that's the premium that is for my life cover and my total and permanent disability.
Oh, yeah. Okay.
And they're what's called a linked policy, which is also quite common. So generally you could get like your total and permanent disability and your life cover linked. Mm-hmm. They need to either be the same amount or your TPD can't be any higher than your life. What happens if they're a linked policy is if I was to claim on total and permanent disability, the likelihood of me then passing away increases.
Right.
Yeah. So when it comes down to risk, like if I've had a medical event where I'm totally and permanently disabled, I can't ever go back to work, something has happened, my likelihood of having a premature death is much higher than just me prior with no illness.
And that's why it can't be more than the life insurance.
Exactly, because what then typically happens is whatever they pay out on TPD, they then won't like double pay out that same amount on life.
Yeah.
You will then tend to get an offset or a smaller amount subsequently on life.
Yeah.
So sometimes that is a way to make a larger sum insured policy for life and TPD more affordable.
Yeah.
Because then you kind of have the best of both worlds.
Yeah.
And equally coming down to the conversation of like, well, how much do I need to be insured for a total and permanent disability conversation? It's very similar to the questions we just went through with life, where you have to think about, okay, if something was to happen to me that meant I could not ever work in my job ever again, what things would need to change in our life?
Yeah.
We would want to be debt-free. One conversation that we would often have with people is like, how appropriate is your house to be able to be lived in by a permanently disabled person?
Yeah, right. Like if it's like 3 stories, probably not. Yeah.
Well, we have internal stairs and a very small 2-bedroom unit.
Yeah.
What is the likelihood that if I was living and able to work, but say like a quadriplegic or in a wheelchair, we would have to move. Yeah. Or at the very least, we would have to make some significant modifications to our house.
Yeah.
They're going to cost in the realm of hundreds of thousands of dollars. Yeah. And if you have to move as a family, it's going to be costing well above that.
Yeah.
So looking through those types of scenarios, then also asking yourself the hard question of if your partner was to be permanently disabled, who is going to look after them?
Yeah.
Are you going to be quitting your job and be a full-time or part-time carer, or are you going to need to cover the cost of that? And that's something that we always built in, because if you're going to be quitting your job, we need to replace your income as a lump sum. And if you're not going to be quitting your job and we're going to be needing paid care, that's somewhere in the realm of potentially $60,000 to $80,000 a year minimum that you need to project out for a period of time. Let's say we need to be able to afford that expense for 15 years. You want that to be paid out essentially in a lump sum. So the idea of TPD is we would get paid out $1.8 million. We would pay off $1 million of our mortgage, or would probably sell our house and use the money to like buy a bigger house.
Yeah.
And then we would invest a sum of that money to basically pay an ongoing income stream to help support the costs associated with the permanently disabled person in the household.
Yeah, right.
Yeah.
Yeah.
It's pretty rough.
Yeah.
Because it's like you lose the ability for one partner to be able to contribute to the household and then essentially become an additional cost on the household. If you have kids, like is the other person able to pick up their entire parenting role? Probably not if they have a full-time job. Do you then also need to factor in the cost of like a nanny? Yeah. So that kind of like the addition to the ongoing living costs is also really important with that calculation. Now, TPD cover is actually not as expensive, because if you think about it, the likelihood of that is a lot less, right? Like it's a lot more common that someone's going to have a heart attack or a stroke or a cancer event than they are to be so totally and permanently disabled that they can never work in paid employment again. Yep.
So just to clarify, you have 1.8 million individually each on life and individually each on TPD.
Yeah. Yeah. And for my cover, that 1.8 life and TPD, the premium for that is $2,800 a year. Luke's will be higher because he's older and he's a male.
Yeah.
So he is a higher risk category already. And then in terms of trauma cover, we both have standalone trauma cover. Similar to you guys, we essentially have the same amount because we have the same private health cover, and we're kind of like, well, if we were paying for cancer treatment, like it's going to cost the same for Luke as it would for me. There's no differential there. Yeah. It's more just like how much would you need as a lump sum to cover costs?
Yeah.
We are insured for just over $200,000
of
that. I think actually similar to you, we started at $200,000 and the just over amount has been like the CPI increases to the sum insured.
Yeah.
And that for me is $194 a quarter. So what's that? Like $550, $600 a year.
Oh yeah, okay. So that's kind of similar.
Yeah. That's my level premium.
Yeah, level. Keyword level.
That's my level premium.
Yeah.
My
you got that when you were 25 as well.
Yeah.
Right? Yeah.
My other two are stepped, which is sort of fine, I think, because I'm like, our life insurance and our TPD insurance, I'm happy to vary those numbers up and down. So I'm less concerned about like, you know, at one point when we were insured for 2.2, I'm like, we're not going to be insured for 2.2 forever. So I don't want to lock in a level premium here because if we just keep that sum insured for 4 years, what's the point? And so knowing that over time we would like that 1.8 number to reduce as our financial situation betters.
Right.
So that's kind of the goal there. And similarly with income protection, we have varied the sums insured for me, but we have not so much for Luke. And the reason that we've not touched Luke's is because he is in a high speciality career and role. And also I believe we did lock in a level premium due to that because he's in a very, very unique role. But when you're in like an office-based role.
Different story.
Yeah.
So just to clarify, when you're doing level premiums, you have to, so let's say you said the 2.2 million, you have to choose, I'm going to be at that rate for 5 years or 20 years or whatever. Can you not vary the amount? Like,
in terms of the sum insured, you can. So you can vary your sum insured at any time. Yeah. The important thing to note is every time you're varying the sum insured to go up, you're going to need to go through medical underwriting again.
Oh, right.
So you're going to be reassessed. Yeah. So if you're doing
but not
that,
down.
But going down is just a reduction, right? So going down, no problem. Now, when you're thinking about the level versus stepped payoff period, that's going to reset every time you're varying the sum insured because your premium is going to reset.
Yeah, right.
So if you are believing that you're going to be varying your sum insured within a shorter time frame because you've just gotten this insurance at the most expensive time of your life, like highest risk factor, you've got a mortgage, you've got 2 kids, there's a lot going on, one parent's not working, like that's the most crucial time. But you know that, okay, 5 years from now, the kids will be in school, both parents will be working, will be a little bit more stable from a financial risk point of view. You possibly don't want to lock in level because the level payback period might be 15 years. And then if you then go 5 years down the track and you reduce it, the payback period starts again.
Yeah, right.
So it's kind of just that trade-off. Whereas I think, say, with trauma, it makes logical sense in my mind because it's like, well, trauma is the cost of a medical event that's so specific like that, generally speaking, is not going to reduce. And the only thing that would significantly impact our ability to fund a trauma event would be much, much better financial situation, which is not going to happen until we're well out of the like mortgage kid paying years, right? So I'm like, let's lock that in because I ain't changing that anytime soon. In fact, maybe I should increase it, but then it's like it starts to get quite expensive. Whereas the other two, it can vary based on just where your situation, right?
Yeah, okay, yeah.
And like I remember at one point I've increased my sum insured for my income protection. I've decreased it. I've increased it again. Like I'm all over the show.
And so also to clarify, trauma sits outside of the linked policy between TPD and life. So that's not linked also to those two.
It's not linked. You can sometimes get trauma that is linked to life. again, to kind of make it cheaper. But we have just opted for one that's outside of life.
Right. Okay. I kind of feel like that we might have that in terms of them.
And what would then typically happen is it's a similar thing of if it's linked, and let's say you've got like $1 million of life cover and you've got 200K of trauma, and you do have a trauma event, your life cover max payout would just reduce to 800K.
Oh, I see. Okay.
Yep. And it's basically just to overall reduce the like cost of the policy.
Right.
But that's also could be fine.
Yeah.
You know,
you get discounts also when you have multiple with one provider, because we have both our life and our trauma with AIA, and we get a 10% discount on each for that.
Exactly.
For the pleasure, basically.
Which is a really good point, because the other thing a fantastic insurance advisor should really be considering for you is if you're a pretty simple person when it comes to a job, like Ollie and Christine, you want to be maximizing the provider that has like a great multi-policy discount. You want to be finding a solution that works really well for them, that is pretty simple to track. Now, if you have someone that's in quite a complex job like Luke as a pilot, or let's say you're a very specific engineer, or you're in a high-risk occupation like a FIFO worker in the mines, you need to be going to an insurance company that is well-versed and covering that type of role, because not all insurance companies treat everyone the same. And that's why, as you overheard me on the phone earlier today, when I was panic researching my own insurance policies in preparation for this episode, I said to the guy, I was like, I always forget where all of our insurance is it's because Luke's is with 3 different providers, whereas mine is all with one, because it was really important for us to have a provider for his income protection that had the best benefits for the pilot occupation. That was the primary thing, because we're like, he has gone all in on this job and this career, and we really need to make sure that that is well secured. Whereas we care a little bit less as to like life and TPD. That can be kind of assessed based on, you know, cost and just overall, you know, variations. And the reason that the cost will vary between providers is because insurance companies are looking at the overall risk across their whole book. Right? So they could already have like 17,000 Ollie and Christines, and they've just decided today they don't want any more. Because maybe they've got too many. Maybe on balance, you as an individual are not actually that risky, but they've got too many of you. And so their categorization of risk and the probability of them paying out across the whole book is also what impacts it. So that's why sometimes like you literally could be getting the exact same benefits from one company to another, but the premiums will vary. It's because maybe one company right now, you guys are a little bit too high risk, and so they're going to place a higher premium on that.
But then does that work in reverse for someone like Luke, where it's like, okay, if you've got a specialist insurance provider that are all in on pilots, like they'll
make you pay for it, but yes, they could just be quite happy to take on that risk, and they've costed that risk, and that's kind of what they're and what they're dealing with.
I see.
For sure.
Interesting.
So that's why like shopping around is good, and trying to figure out, okay, well, you know, do we want to lean in on something like a multi-policy discount and just have everything with one provider because it will be simple and I'll get a good deal on like the multi-policy piece? Or are we okay to have like a few different pieces here and there, knowing that just adds to your overhead burden of like financial admin, but stay lovey. Just don't become like me where you're like, where is my insurance? What's happening? As long as it gets paid, I'm like, it's fine.
Happy days. Love it. Okay. So on your life and your insurances, we haven't really spoken about income protection. So let's just round that out, and then I have some quick fire questions to finish.
Great.
So what do you pay? Your income protection.
So income protection is the most simple in the sense that basically it pays up to 75% of your current income. So you could be the sum insured, the monthly amount is up to 75% of essentially your monthly pay. Now that would just get paid to you if you were to claim, and because it's income, it then needs to be taxed. So standard procedures apply. It's income. It's coming on through as income. It's getting taxed at your tax rates. And the idea is that it just basically maintains your income at a lesser rate. Now, they're not paying you 100% because they're trying to incentivize people to return to work. So that is important. And that's often why people then complement income protection with, say, trauma or something else, or making sure you have emergency accounts and savings, because you are going to have that like guaranteed 25% reduction off your income. So right now, I am insured for roughly $2,000 a month as a sum insured. That's pre-tax.
Oh, yeah.
I'm just going to mentally, if I got a calculator, I really should have done this
I thought you did. I thought you said it was like 92K or something.
Oh, yeah, okay. So this is in Australian dollars. So I'm just trying to turn it to New Zealand dollars. So that's 102,000 roughly New Zealand dollar salary.
Yeah.
Which is not actually what my current salary is.
Is that pre-tax as well?
That's pre-tax. Yep. So that's gross.
Yeah.
So gross, that's not what my current salary is. We could increase it to what my current salary is, but the consideration that we have with that is if I was actually to stop working, would we need all of my salary?
Yeah.
Like right now we're saving money and we're kind of living a bit fun. Like, you know what I mean?
She's in her spending era.
Yeah. Like we're using savings to go on holidays, like those kinds of things. That's not happening if one of you is off work because you've had a medical event. So I am relatively comfortable with that because as long as we're insured for the amount to keep up our base level of expenses and also assuming that Luke is working, then that's okay. But often the starting point for people, particularly early on when they get insurances, and starting point for me was let's just go to the full 75 of my income. Now, of course, if you're like 45 and you're an exec and you're on 500K a year, you're probably not going to insure 75% of your income unless you're really, really bad at saving money.
Or you have like a massive mortgage.
Exactly. So that's where I think like when you're starting out, the 75% thing is completely relevant. Yeah. But then it's a case of like as you're going through those annual insurance reviews with your provider, you want to think about that. Now, in terms of how much that's costing me, it's a real cheap $22.53 per month.
And is that because you leveled it when you were 25 as well?
Yeah, I had it locked in early.
Did you just randomly choose like $100,000?
No, I think at the time that I went through it, my Australian salary was 85K.
Oh, yeah.
And so I would have insured it for 85K. And then I think we did do a step change when I first got my job at Kernel, or perhaps started like contracting and my income was a bit higher.
Yeah.
And then it also just increases with CPI.
Yeah, okay.
So I varied the sum insured up once slightly, and then it's just increased with CPI. So yeah.
And is this a New Zealand policy?
No, it's an Australian-based policy because we've not transferred them. You can't really transfer them, so that's kind of another thing.
Yeah. So I mean, that's in the quick fire questions. Is do policies apply through countries? How does that work?
Yeah. So it's a little bit of a nuance. You have to be a resident in the country that the provider is in at the time in which you take out the policy.
Yeah.
But you can then often get what's called worldwide coverage. So at the time that we took out all of these policies, we were living, working, paying tax in Australia, and we continued to do so for many years subsequently. And we then moved to New Zealand, and we now live and work in New Zealand, but we are able to keep these policies active as long as we're paying for the premiums and we're still valid for them to pay out. We don't need to be resident in Australia for them to pay out. The reason that we have opted to do that is if we were to get another policy in New Zealand, you have to start from scratch. And that would result in medical underwriting.
Yeah.
Since we took these policies out, Luke has had 2 surgeries and 2 periods of time off work for medical reasons. And so that's going to be scrutinized, and he's probably going to get what's called exclusions, i.e., you burst an eardrum and we think it's high risk that your eardrum is going to burst again. So you're going to have an exclusion on your ears. So if anything happens, this literally is how it plays out. If anything happens with your ears that means you can't work, we're not going to pay you.
Yeah.
This is why, Tim, looking at you, you get insurance in your 20s. Yeah.
I have exclusions in my policies too.
I've been on antidepressants at various times. I will have a guaranteed mental health exclusion.
Yeah.
I have also had a pregnancy, and that has had like other medical complications like high blood pressure. Post the fact, I will probably have some kind of exclusion or loading based on those things. Yeah. So the more things that happen to you throughout your life, the higher likelihood of having an exclusion. Now, exclusions can be a little bit of a killer because exclusions are basically just where the insurance company is like, if that thing happens to you, we are not going to pay out for that type of event, but we'll pay out for everything else. Yeah. So that can be a bit of a trap. It's still worthwhile considering insurance if that's the case, because there's lots of other things that could happen to you that you might need cover for, but that can be a bit of a bugger. The positive with exclusions is depending on what they are, and you do often see this with mental health exclusions, is that there can be a period of time in which they can be reviewed. So they are sometimes reasonable about the fact that like, okay, we see that you had, like we used to see this with clients where perhaps they were on antidepressants or medication for postpartum depression, but they'd not have any other like event of mental health in their lifetime. It was very specific to that moment in time. And so the insurance company would say, okay, we're going to apply this exclusion for 5 years. And if no other mental health event happens during that 5-year period and you're off medication, then we will remove it. Yeah.
I have that in my policy. I have a 5-year mental health exclusion as well.
So that can be okay. The harder thing or the other thing that can come into play is what's called a loading. And a loading is generally for a health condition or something to do with you, i.e. smoking is the most common one. If you're a smoker, you'll have a smoker's loading. So they will basically quote you on like, here's the standard premium if you were just a regular healthy person. But because you're a smoker, we're going to apply a 20% loading. So your premium is going to be 20% higher than that because you're higher risk. Now, you could have loadings for other reasons, like, you know, potentially high cholesterol, sometimes based on hereditary factors. You can also get exclusions based on hereditary factors, which is pretty rough, but
that is rough.
Also understandable. So, also, I would say part of the reason people don't get insurance is because the person that is going to know the most about you in your life is the person that is helping you fill out the medical application to go through underwriting. Oh my God, that is a great question. Did you go through the medical application?
Yeah.
You did? Okay, great. Oh my God, okay. Okay, because the other piece of like jargon and information we need to cover is that there are two different types of, particularly with income protection, two different types of policies you can get: agreed value and indemnity.
Right.
With income. And then there is also very common with life or total and permanent disability. People have the option to basically go through the medical underwriting at the time, or they go through the medical underwriting at the time of the event. Now, if you go through the medical underwriting at the time of the event, your insurance policy and premium is going to be cheaper because you're not doing it up front. But that is a high risk option because you're delaying the time in which you're going through medical underwriting, right? So we would always suggest to people that you go through the underwriting and all the ins and outs of the medical stuff from day dot, so you know where you stand, and then you lock it in on that basis because you can't guarantee what's going to happen to you over the next however many years.
Nice. Yeah. Good.
There's so many things to think about.
I know. I am honestly going to go back and re-listen to this podcast like 3 times because I was like, I stopped taking notes of things that I need to change in my policy.
Do you know about indemnity or agreed?
No.
Okay, so we'll just quickly touch on this. It's in relation to income protection. Agreed is doing what it says on the label. It's paying the sum insured to an agreed value.
Okay.
It is agreed in my policy that I am earning $6,752 a month. So if I was to stop work, I don't need to provide any proof to that company as to how much I have earned.
I see.
It's irrelevant. They assessed my financials and what I was earning at the period of time in which they insured me for that amount, and it was agreed that whatever time I claim, I'll get paid that. Now, that can be fantastic, particularly if you're a female, because if you're on an indemnity policy and I'm insured for $6,700 a month and I go on mat leave and I don't work for a period of time and something happens to me and I need to make a claim, they're going to then turn around and say, show us your earnings for the last 12 months and we'll pay you 75% of that.
Because literally nothing if you're on mat leave.
Now, that's also really hard if you are going through like job changes, employment changes. You know, I've had significant steps in like income both up and down based on various career moves. So that is high risk. Now, again, you're going to pay less for an indemnity policy because the risk is on you, and you're going to pay more for an agreed policy because the risk is pushed back onto the insurance company. Now, again, it's one of those things of like, you have to pick the solution. Luke, it's like 100% we're going to basically lock in agreed. Also for me, I was pretty chuffed to lock in agreed because I'm like, this just sounds great. But those are another one of the levers that I guess your insurance advisor could help you pull to figure out what's affordable. Just knowing that like obviously comes with trade-offs in terms of like who's taking on the risk.
Nice.
Are you taking on the risk or is the insurance company taking on the risk? And if you want them to take it on, you got to pay for the privilege.
Yeah. I feel like everything in finance is ultimately about risk. Yeah. It's like you think about getting debt or a mortgage. It's like, well, how risky are you to the bank?
Yeah.
It's the same thing. How risky are you to the insurance provider, essentially?
Yeah. And I feel like this is so nerdy to say, but I actually kind of loved doing insurance stuff with people because I'm like, you kind of remove the emotion from it. And it's just like, what risk are you willing to take? Yeah, here are the facts. What risk are you willing to take on? What trade-offs are you happy to make? What things in the future in like worst case scenarios are you willing to cope with? Like, and a lot of people are not comfortable in having that conversation, but I would just say to them like, what is worse, having this hypothetical conversation that we are right now and feeling a little bit upset about the prospect of your partner dying or being faced with that scenario happening after the fact where you have absolutely no recourse. Yeah. We had someone earlier this week say to us, they constantly get reached out to by people that have had medical events saying, hey, I need to get insurance now because I've had a heart attack and I need financial help now. And they have to have the tough conversation that is like, you've missed the boat.
Yeah.
That's not what it's for. Insurance doesn't pay or agree to pay for you retrospectively. Yeah. You have to get it whilst you're fit, healthy, and everything's chipper because that's the prime time. And there's also prime time when you don't feel so bad about thinking about the worst case scenario.
Yeah, because you're like, oh, I'm invincible.
You don't want to be in the worst case scenario and thinking about the worst case scenario.
Yeah, that's very true. Very true. Okay, I have some quick fire questions.
Okay, go.
And so first one, do you pay tax on life insurance payments?
Great question. No, you don't. Generally speaking, you need to think about tax is in relation to income. So you pay tax on income protection because it's replacing your income. Life insurance is not typically replacing income. It's just paying out a lump sum to a beneficiary. So life insurance, no. TPD insurance, no. Trauma, no. Income protection, yes.
Yeah. Okay, cool. Love it. What is a whole of life insurance policy? Do you know what
Great question. It's essentially just sort of like a jargony definition, but you're essentially just getting a life policy for your whole of life. So it'll cover you right up until you pass away.
Oh, I see.
Yep. Okay. Some life covers might tap out at 65.
Oh, I see.
Or expire. Some insurance policies can have an expiry date. So it's more just saying like this will cover you for your whole of life. And as long as you own the policy and pay the premiums, you're guaranteed to be paid out or your estate will be paid out.
Nice. Love it.
Yep.
I had what are typical life insurance exclusions, but I mean, I don't know if it's pretty like situational.
Life insurance exclusions are actually less common than exclusions for other things because if you think about it, like they're not necessarily excluding you from things that could commonly kill you, like illnesses.
Yeah.
But if you're wanting to get cover like TPD or trauma for an illness that's highly likely and you have a predisposition to that illness, they're probably going to apply an exclusion. Yeah, exactly. So the one thing that is the primary exclusion for all life cover is non-accidental death, which is essentially death by suicide.
Yeah.
Yeah.
Yeah, I see.
Yeah, but outside of that, generally speaking, most life covers don't have many exclusions.
Right, okay. Is that not the same thing as mental health exclusion though?
No, because I have a mental health exclusion on my income protection policy because it's much more likely that I would need to take time off work for stress, burnout, like anxiety.
I see.
But if I was to, if you play out that scenario and be like, if I was to pass away because I was stressed and anxious and then I got cancer.
Yeah, right.
They would pay out.
Yeah, I see. Yep. Okay, yep. Got it. Okay, cool.
I really love like negative scenario planning, as I can tell. It's like, stop talking about this.
It's like death series.
I know.
Okay, so I mean, for someone listening, if you're hopefully not overwhelmed by this point, some people might be, and they're like, well, what is the actual difference between all of like
the covers?
Yeah, well, less about like life versus trauma versus income, but in terms of the different providers, like there's, you know, AIA, Partners Life, all these different things. Ultimately, like let's say for each one, it's the same cover in a different form. How do they differ? For
sure. Yeah. Again, it's kind of just what we talked about in terms of like they all broadly speaking offer the same stuff. Some of them might just have specialities in terms of the type of cover that they particularly like to deal with or the types of individuals that they particularly like to deal with. So the first thing to think about when considering different providers is just that question of like, do you work in a particularly niche or specific role?
Yeah.
Do you have qualifications and a job that's quite individualized?
Yeah.
And if that is the case, start Googling that and insurance so that you can narrow down your providers. Because for the likes of Luke, basically there were only 2 providers in Australia that would cover pilots.
Yeah, right.
For own occupation. Yeah. So they would cover him for income, like loss of income, if he couldn't be a pilot anymore. Now, there's lots of providers that would cover him for loss of income if he couldn't work at all, but we don't really care about Luke being a gardener. We care about Luke like not being able to work as a pilot because we're very reliant on that income, and that's like what he wants to do.
Yeah.
But that's kind of your starting point. That'll narrow down your options. If you're just, you and Ollie and like a little bit more kind of generic, not offensive. But,
We're vanilla. It's fine.
You're a bit more vanilla in your options.
Yeah.
It's really like shopping around.
Yeah. Okay.
And the other thing I will say, before you shop around, the benefit of talking to an advisor is if you believe you're going to have exclusions applied to you based on your previous medical history, you need to front foot that because various providers will treat things differently.
Yeah,
so the real value add that an advisor can provide is they will know how does AIA treat a mental health exclusion versus like Partners Life or Pinnacle, because they'll have their own policies on that. And so they will know, okay, this is your insurer that's most friendly to this. This is your type of insurer that is most friendly to like hereditary family history. So those are the factors that might just then narrow down who you go with.
Yeah, nice. Something that my insurance broker said to me was that also different policies can have different wording. So like around the payout, and some will guarantee that they'll pay out certain things, others won't. And so you need to be careful and make sure you're reading how things are worded, because ultimately if you get to a point and you become in an argument with the insurance provider, that's the thing that they're going to point to.
Definitely.
With that.
Definitely.
Yeah. Cool. Getting life insurance as a couple versus individual.
Say more about this?
Like, I guess, so I think about Ollie and I.
Yep.
And like,
oh, do you mean as like, should you consider it together?
Yeah.
Or because you're not married and you guys don't have kids, should you just be like, well,
I'll have my policies, you have yours?
Yeah.
Is it better to keep them separate, or do you, because I assume you
question.
can link them, right?
You can link them, and which is why I would question you guys to go answer that, because you said yours is personal, joint and survivor.
Yeah.
Luke and mine are individual.
Right.
And typically we would assess it on an individual ownership basis, but if you were a couple, you would consider it together. But that's where the devil in the detail is having that conversation, where it's like Luke has different wishes if he passed away to the wishes that I have. We have different like beneficiary interests in mind and family scenarios. And so you don't need to go into it with just like, we have the same amount of sum insured because we have the same mortgage that we co-own.
Yeah.
You might genuinely have different intentions for things without the other person being there.
Yeah, cool. Nice. Do you think a will is like a precursor to insurance? Because if you're getting these payouts.
Well, you have to have a will, right? I mean,
Because then it doesn't.
So, I mean, you can have a named beneficiary for a life cover. So essentially it can be paid out to a specific person or the named beneficiary is your estate. Now, if you have a named beneficiary and that person is Luke, and I have made an allowance in there that's set aside for Lily's education, I am just putting blind faith in Luke that he's going to make some great choices about that when he's traumatized and upset.
Right.
Yeah. So that's why people tend to also put life cover or cover aligned with like estate planning, because you can have your life payout go to your estate and it can then be dealt with in accordance with your will, which enables much more flexibility and provisions for different stuff.
I see. Okay.
Yeah.
Good.
If it's real simple and you're basically just like, this is just, I have life cover to pay off a mortgage and that mortgage is owned by me and my partner, it would make sense just to make them the named beneficiary because they can get the money and pay it to the bank. The end.
Yeah. Cool.
Yep.
Love it. And so to round out these
epically long, depressing episode, I'm sorry, Tim, for all this editing work.
If a listener is sitting here thinking kind of what I'm also thinking right now, holy moly, there's a lot of details and I probably have the wrong policies, or maybe I don't even have a policy.
Yep.
Where do I go and how do I start? Because I also think like, how do I find an insurance advisor like you, in the sense that... Yeah, you're welcome.
Thank you.
Just, someone that also knows
Yes.
about all the details, who's really thorough, that kind of thing. Because in the same way that you can get a really great doctor and a really bad doctor, you can also get a really terrible insurance advisor and a very good one.
Yeah, exactly.
Things to look for.
Yeah. Okay. So good place to start, because we did struggle a bit to find some great online tools, but I did really like Pinnacle Life, which is a provider, have quite a helpful calculator on their website where they basically talk you through various scenarios. So they're somewhat posing the questions to you online that we just talked about and trying to set the scene a little bit. Now, that can then help you at least get a sense of like, what level of cover am I potentially looking at? And that could be a good place to start. Equally, if you already have a provider, you could go to that provider and say, what is an advisor that you guys like recommend and use, right? Because a lot of insurance companies, particularly in the life space, get their customers, it's not direct, they're coming through an advisor. So I'm going to assume that the team at Pinnacle Life probably know who the fantastic advisors are that work really well with their products, and they could narrow down the shortlist for you. I think that would be a helpful place to start. The other one would then just to be looking for an advisor that is happy to really think about the wider picture, and not just sell you a product. As we've talked about, there's a very big difference between just getting someone that's going to sell and sign up a product for you and deal with the wider picture. Now, why do you want someone that's dealing with the wider picture? Because like a mortgage, if an advisor is setting up a policy for you, they are going to get commissions on that for a very long time. And in fact, that should entitle you, because those commissions are quite significant. Like they are a lot. That really does cover the upfront amount of time that that person can spend with you, and then also cover reviews that you can have on that product ongoing. So I don't disagree with the commission structure with insurance, because I actually feel like, and have had the experience, that it's a lot of work for the advisor, because we've just talked about it for an hour and 15 minutes. Like there's a lot of considerations and that's their job, and then they have to research and do all the stuff. So that commission structure is fine, but it does mean that you really need to like put them under pressure a little bit to make sure that they're interrogating some of the stuff that we talked about. And if you get the sense that they're not, find another advisor. Until you've signed up for that policy, you can go and do that. Once you've signed up for the policy with an advisor, it's very hard to then transfer that to another advisor. And this is essentially where you start to get a little bit stuck, because even if you were to then go to a different financial advisor, oftentimes they won't then pick up the advice piece of your insurance, because if there's a separate advisor attached, how it essentially works in the back end is that there needs to be like an agreement of payment between those two advisors. And that's a bit niggly. So finding the person that you want to work with first is important if you're not going to go direct yourself. Another option, not sure how many people are out there, but you could do the research and see if you find someone. If you just want someone to help you figure out this conversation that we've had and talk you through the calculations and sense check your maths for the sums insured, and then you feel confident enough to call up Pinnacle and be like, hey, I need a quote for $1.8 million for life. I want it to be stepped. I want it to go to this age. Like they're just putting numbers into a system, and then they're going to send you a quote.
If you
could do that yourself. It's harder. And I recognize it is harder. But if you knew some of the technical nuance, like what's the benefit period? What's the waiting period you're asking for? Do I want to assess stepped or level? You could do that.
If
you're like, should I?
For me, if I already have a policy with an existing insurance, can
go
I
back to them? I'd go to them.
Could I
make them work harder?
Well, I was going to say, could I cut them and then just go direct? Like, because then if I know what I want, do you know what I mean? Like, what happens there?
I think if you were not happy with the advisor, but you wanted to stay with the provider, I feel like you could probably call up the provider and see if there's a way to turn off the associated advisor commission.
Oh, that's rough for them.
I mean, look.
I'm not saying that's what I'm going to do.
But it's the risk. It's the risk you take as a service provider that's at the behest of,
commissions. I feel like a one-off insurance advice session could be a good idea.
So do you know what's interesting about that? When we did this at the advice firm I worked for before coming to Kernel, we stopped taking commissions on any insurance product because we didn't believe it. Like we didn't believe in commissions, and we'd stopped doing that on every other investment product for a very long period of time. Now, insurance was the last one. We stopped doing that and we started charging people a fixed fee to cover the insurance work in addition to their overall financial planning. And the reason for that is, as we've just talked about, it's way more complex and it essentially needs its own separate meeting outside of like, what's your retirement planning? What's your budget? All that kind of stuff.
Yeah.
Now, we got probably like 18 months into that. And with the challenges that we found with getting insurance across the line with providers and the amount of work done in the back end in terms of implementation, we ended up having to reintroduce the commission because it just got to the point where the fixed fee that we were going to have to charge was too high and too unpalatable. Because the problem is, like, let's play out a scenario where I recommend you AIA and you're like, yep, looks great. You go through the application process. We do all the medicals. AIA look at you and have assessed you in a way that I have not anticipated and they decline you. I then need to find somewhere else. And I've got to do that work all over again.
Yeah, right.
And particularly with the increase in like mental health becoming a concern for insurance providers and just the prevalence of people taking time off work for mental health related things, this was happening a lot.
Yeah.
The other thing is that every time you're declined, it's basically a black mark that can then be seen by other providers. So the worst case scenario is that you put someone forward and that they're declined for insurance. It's not like that with a bank. If you go to ASB for a mortgage and they decline you, and then you go to HSBC don't give a shit. They don't really see what's happened with ASB, but that's not the case with insurers.
Yeah, right.
So it then often happens that if you have a client that just has not even a complex medical scenario, but just a you and I medical scenario, you would go through what's called a pre-assessment. We would basically send a blind assessment of your medical history without your name to the insurer with the information, the policies that we want to apply for you, and they will tell us what the outcome is.
I see.
So we would do that for, say, 4 different providers if we felt like your medical history and situation was going to be tricky to then see what the best outcome is and then come back to you as the client to say, hey, this first provider that we wanted, they're going to apply some exclusions, but this provider over here, slightly more expensive premium, but no exclusions. We're now suggesting this. Like, there's so much work that can go on there. And that's where I'm like, okay, commissions are valid because then ultimately that advisor is paid based on the premium that gets signed up and has that continual kind of commission structure ongoing to help support with that like premium or that policy throughout your life.
Interesting. I find that fascinating because I've definitely always been like, why would I pay a commission with insurance? But it makes a lot of sense because of the amount of work that they put in.
And that's different. Like, can you see what's then different to KiwiSaver investments, right?
Yeah,
it's like,
sure.
That's not a thing.
No.
But the reality is there is a lot of nuance to finding the best outcome for the client or the customer in insurance. And it could mean quite a lot of legwork before you even get to the point of having an active policy.
Yeah, for sure. Nice. Love it. I feel like I have one more question, but that's all right.
Well,
we can save it for another episode.
Exactly. I feel like we have covered a lot in this and really gone deep onto it. So we're probably going to make this a 2-parter, which means you've just listened to the second part. And if you have any questions, please do reach out because I think, you know, as you point out, and as we literally found out, there's not a lot of fantastic calculators and resources online. We're very heavy on resources of property and car insurance, and very light on resources, great personal insurances. But we do know some good advisors. So if that's your starting point, happy to help get you into the right situation with an advisor. Otherwise, slide into the DMs, hey?
We look forward to a chat.
We love a chat.
Yeah.
Wonderful. Great. Well, big thanks to Kernel for enabling us to do what we do. Don't forget to hit like and subscribe wherever you're tuning in, whether that's video on YouTube or listening on Spotify or Apple Podcasts. If you have any questions about this episode or any others we've done, please get in touch at It's No Secret NZ on Instagram. Send us episode requests, feedback, and more. We will see you next week.